Hello, everyone, and welcome back to not a breakfast show, but deep dives. I guess deep dives, we can call it deep dives. We have Emir here. Some of you have asked, who is this guy that we've been talking about for a while now? Well, here it is. Here it is. Type F Capital. Welcome.
Damn, that was a long countdown, dude. We sat for like 3 minutes. I don't know what.
2 minutes.
Restream, bro. Yeah, happy to be here. A good friend of Couch Investor. I didn't know that you talk about me that often, so I hope
people ask about mafia stocks, so I always.
Oh yeah, that's a good term and a good place to invest, if you ask me. But yeah, no, I don't really know what to say. Yeah, I post equity research on my Substack, and that's about it.
Yeah, we're going to. Do you still stream or make videos, or more focused on the Substack?
You know, the Substack is the main focus, but I kind of need to do videos because you kind of need traffic to the Substack, right?
Mm-hmm.
So whenever I did a challenge in July because I had a month off, so I was gonna do one video per day, and I realized quickly how difficult it is to do what Couch Investor does, because I ran out of topic in like 4 days. I'm like, what should I make a video on? So the quality went down. So I've decided that, yes, I will of course keep making videos, but I'll only do like really high value videos. Like I'm not gonna make a video for something small. So I typically, if I post something, it's gonna be like a deep dive, a really valuable video. And my content, I'm just warning you before you go, oh, let me go check out his YouTube. My content is not forever. It's like 15 minutes and we're looking at Excel sheets. So if you're into that, you're very welcome. If you want, the quick and dirty and, very much information in a short amount of time, then it's better to just keep watching Couch Investor. But if you're interested in both. Yeah, so if you like the numbers, you like the Excel sheets and stuff like that, then you're very welcome to find my YouTube channel as well.
Perfect. And everything's linked in the description as well. Quick personal news. Google did announce that they're going to invest $5 billion or 5 billion euros in Belgium. This is all thanks to myself. I've been pumping Google for the last couple of months. So I guess they're like, you know what? Here you go. $5 billion of an investment.
In 2 days, Belgium is going to be, and we are investing this 5 billion back into Google. What do you think of this recent like circle investment thing, like
flywheel?
Yeah, like OpenAI invests into what was it? Nvidia invests into I don't know.
Nvidia, OpenAI, OpenAI, AMD,
Oracle.
you have CoreWeave, Oracle. There is
Yeah.
actually, I have,
Everyone passing
uh,
around $100 billion that no one really has on their balance sheet, like just in a circle. Crazy.
there is this picture right here from the Financial Times that shows the $1 trillion for OpenAI in compute and all of that. So it's OpenAI here at the top. You then have Investor Cloud AI integration with Microsoft, which Microsoft is a customer of CoreWeave. You can go all the way to the other side, Cloud AI integration partner, Amazon, investing hosting into Anthropic. They also have Google that's investing in Anthropic. You have a data center deal with Google. So it's all connected. It's all connected. So we do have here NVIDIA that does sit a little bit in the middle um, for now. For now. But yeah, it is a nice. It works probably because a lot of these companies here are making already quite a lot of money with their core businesses. It wouldn't have worked
I
without it.
was going to ask you, when do you think that we hit the ceiling on the capex investments from these like hyperscalers? Because there has to be a ceiling, right? Like you have to show to your investors that you're actually extracting value from these billions and billions and billions, hundreds of billions of capex investments. And when there's a new chip every single year and you need to remake the whole investment, sooner or later you're going to run into this ceiling. So when do you think that happens? I think it's an
Good
interesting
question.
conversation to have. And another conversation, well, we're not going to get into it today, but the ASIC versus the GPU conversation is also interesting. But just the quick and dirty, when do you think we hit a ceiling here? Like when is the, I wouldn't call it the bubble,
CapEx
but
cycle?
yeah, exactly.
I'd probably give the huge CapEx cycle another 2 years. And then it's not like we're going to see it plummet. I just don't see it grow as fast as before.
Yeah, I imagine something like the typical semiconductor cycle, because that has existed even before, the whole AI hype. Like the semi business is just cyclical by nature. So I imagine something like 2 years as well. Actually, we're kind of aligned
Yep.
there.
But we're only talking also about specific big companies. All of these smaller enterprises are also investing in it. Countries are investing in it. So we're still talking about hundreds of billions of dollars of capex over the next couple of years. And then the questions about return on investment will start to pop up way more, for sure. For sure. But in today's live stream, we are going to talk about what is turning into what was PainPal. Some say it's turning into GainPal. I think we're still far away
Yeah, I
from.
saw that comment. GainPal.
We're still far away from what I believe PayPal should be worth in the future. This was something you wrote back in August, which, if we're being honest, since then I don't think that the price has changed that much.
I didn't type it. I only typed out the current market cap, so I don't actually know what it was back in August. But yeah, it's been range bound. I mean, we've had this kind of, it has gone to 80 before, right back to 60. That's happened like 5 times already since I started covering this. So I wouldn't be too excited yet, but the value is there. And I think what PayPal really lacked, which is starting to happen now, is they didn't have this, a catalyst. They didn't have something that got the market excited. They've been talking about doing what they're doing now. They've been talking about it for a year and a half. It's just like they have all these legacy platforms with their merchants that they need to replace before they can actually start to roll out new features, with the updated, more modern platform. So I mean, they've been talking about the same things for like a long time, even before they switched the CEO. So there's nothing new. It's just that they didn't really have a catalyst. You couldn't really see the results. And now when they're actually coming out, on-site, off-site ads, in-app, all these different things are starting to happen. That's why I think that PayPal is actually starting to see some interest in the stock quote. But as you mentioned, I mean, this is nothing compared to where it deserves to trade, if you ask me.
Yeah, so back in August, you said it had the fair intrinsic value was
Yes.
104% up. So I think we're a bit under the price we're at today. Today we're at 75 or so. So this was still in the high 60s. Um, but yeah, the the sentiment is a bit changing in the last couple of weeks. More recently, because of the announcement of the small launch, well, for small businesses, the small launch of the ads platform into early 2026. I do think that the next catalyst is just the growth acceleration that should happen from Braintree Q3, maybe Q3, Q4, definitely, because the year-over-year comparisons become easier from here on out. But what do you think people are missing? What's the big disconnect? Because I mean, to reach your fair intrinsic value, we still have a long, long way to go. Of course, you did not include anything with
No.
regards to ads and nothing with regards to PayPal World, correct?
Yes, exactly. So ads is not even included in the model. So you can go down to the model actually. It's fine. You have the
This is the
not that
reverse
no no
DCF.
no the actual model. I don't know if it shows up well on stream actually when it's kind of. So
We'll
you see,
see.
it's a long it's a long report. I covered a lot.
But it's worth reading for any bag holders or future
Yeah,
millionaires
that
in
one.
PayPal. It's worth reading.
So basically, this does not include anything crazy at all. I mean, the we're talking like single digit growth is what I'm expecting from the revenues uh, over the, the next 10 years. I'm expecting them to lose market share. The only thing that I'm kind of bullish on that they will solve under Alex Chris is I think they will start to improve their operating margins a bit. He's been
Mhm.
talking about exiting the race to the bottom, actually starting to look at margin expansion because they believe that they can provide more value than a Stripe, for example, with the whole vault and everything like that. So the only thing that is actually kind of, where I'm excited for PayPal here is margin expansion, but revenue growth. I mean, I'm not expecting a lot here. I'm expecting like single digit compounded, and still, it at the time it was a double to fair value, and still, it is still a double to fair value from here. Even after it's gone up a bit, and that is not even accounting for ads. So, I mean, even with small assumptions, this stock is just way too undervalued. Like it is crazy that it's been so disrespected for so long.
So because one of the main, I guess, counter arguments is that one, of course, who uses PayPal, but that's an argument that can clearly be countered by just looking at the data. Two, what about Apple Pay, Google Pay, and all the competition? Aren't they losing market share? But in your model here, you have them actually losing market share, and still
Yes.
they manage
So
to become a better business.
let's get this common misconception straight, because when people, let's take someone that's not into the stock, that hasn't really looked at it, when they hear PayPal, they think about the product where you log into paypal.com and you use that to send money to a friend, or they think about checking out using PayPal specifically. But actually, the majority of PayPal's business is payment processing, powering
Mhm.
checkout solutions for others, even if PayPal is not even an option. Like, even if the only checkout options offered are like Visa and MasterCard, or a buy now, pay later solution, for example, it's still like PayPal powering that. And that's the majority of PayPal's business. Like, when you think about PayPal, like the common person, as I mentioned, when they think about, logging in and sending money to a friend, or buying something from someone using like a PayPal account, that's not actually the majority of the business. So when people start to realize that, and when people start to realize that Venmo is starting to accelerate growth, it's still in the low teens as of Q2, but all signs point to that actually accelerating towards that like 20% growth mark. When they realize that PayPal actually owns Venmo, when they realize that the payment processing business is actually powering about 15% of all online transactions, then they start to kind of realize that, oh, okay, maybe this is not such a dead business as they might have imagined initially when they just hear like the word PayPal. So I think that's really working against PayPal in terms of, getting people excited about the stock. And to be fair, there hasn't been a lot to be excited about in regards to PayPal for a while. I mean, obviously during COVID, everyone started shopping online. The stock went insane. I think it went to like 350, 300s at least. And then obviously they made like bad acquisitions. They didn't know what to do with all the excess liquidity with the cash, made bad M&A deals. Like they had no idea what they were doing. Stock dropped. They replaced the CEO. Alex Chriss came out. He replaced more or less the whole management team. So this is like a whole new PayPal, and they're actually starting to execute. So it's starting to be exciting to follow this company, especially when we talk about ads. Because, sorry, do you want to say something? I don't want to just talk to myself for 10 minutes.
No. It's I have some things I will ask after, but finish.
Yeah.
Finish your
So
train of thought.
the major thing here that people need to keep in mind, because this is a competitive business. As I mentioned, people say Apple Pay, Google Pay, Stripe, Adyen, Fiserv, competition is a lot, which is why everyone's margins have been coming down. However, PayPal does actually have a moat. And I don't think a lot of people realize that PayPal actually has a very, very strong moat. And that is their vault. And the vault actually is PayPal's keeping data on every consumer using the payment processing solution. So I think the last figure that we heard management mention, more than a third of all credit cards in circulation are actually stored with PayPal. Imagine that globally, every issued card in circulation that is active is stored with PayPal. So that means they know everything about your shopping patterns, what you like, what you dislike. When you use this card, you want something shipped to this address, or maybe when you use this card, they automatically know that that's a business card, so it should be shipped to this address, even though it's the same person. So they have all this vast informations of data, and they've not really been leveraging that. So when they start to do that, and that's why I think the ads business can be so powerful, because essentially they have the best data for an ads business out of any company. Like Meta, for example, known for having a great ads business, but they don't really know your actual purchases. They just know like your habits as a person. Like then they know more about your relationships, your interests. But PayPal actually has all the purchase data, which is a lot more valuable in the context. So when they actually find a way to leverage that, I think it's going to be very, very powerful for PayPal.
I agree.
And I just have to add to Roberto, I'm not wealthy at all. he's been making comments about how rich I am. I'm not
Everyone here is
wealthy at all.
making stories. Alex
But
Carr brought his first Palantir shares from him.
But it is true that I did buy Palantir in the single digits. That part is true, but I'm not wealthy by any means.
Apparently, your headphones are extremely good headphones.
They are expensive, yeah. I'm not rich. Expensive headphones.
He also owns an expensive keyboard.
Okay, move on. What are you saying?
I come back to the ads business in a bit. The other argument is, of course, the take rate argument.
Yes.
Right? It's take rate is coming down, and so this business is definitely not going to grow in the future. You have, in this case here, total take rate for 25 at 1.85%, going down a little bit. Actually, no, wait, what is it? 1.85%, then actually continue to go up. It went down before. You think the bottom is in 25 for total take rate?
Yes, and the argument is that they will actually, as Alex Chriss has been mentioned, they will actually start to focus on that margin improvement, exiting the race to the bottom that everyone is participating in. Because when it comes to payment processing, as of right now, it is more or less like who can undercut each other in terms of like, okay, I'll offer it for cheaper. And that's, what's been happening for many, many years now. I mean, if you look at the take rates, like going back to 2013 when PayPal went public, like it's just, a line, that's going the opposite of to the moon. Like it's been steadily going down. So when he says that, no, actually, every merchant with us is connected to the vault, we can actually start to offer value that other payment processing solutions can't, which is why we will be able to raise margins. So that is the narrative here for why I have a slight increase, but we're not talking about like some like huge increase. Still by 2034 I have them less than 2024, so I still have that margin pressure, but I still believe that 2025 will be the bottom, and then we will see some small incremental improvement. So the core point here is, even though it might not seem bullish that 2034 is the same as 2024, like, well, nothing happened in 10 years, but you have to keep in mind for the past 10 years it's been going straight down. So even just stabilizing and keeping it roughly the same is a huge win in the payment processing business.
And then to actually see the big difference, you have them going from 16, let's go 17% operating margin to 20% operating margin consistently. So that stays flat here at 20%. Free cash flow margin, which was also something that free cash flow for PayPal has been staying flattish, right, for the last couple of years, I would say.
No, it's actually been going
now
down.
it has increasing. Last year has gone up for the first time, I think.
Yeah, no, I want to highlight something. I don't know how many people here are really interested in creating models. When you have this idea for where you think the business is going and trying to put that into numbers. As he mentioned, if you look at the operating margins here, I have the final 5 years, I have them flat at 20%. And some people might say, like, people have this obsession with like putting something there just so it seems more accurate, even though like I could have made it 20.03, 20.07, like just to make this like facade of, oh, it is so accurate. But that's just a waste of time. Like if there's no support for it in your narrative, it is fine to leave it flat for the periods where you don't expect anything drastic to happen. Like someone from the outside looking in might be more impressed if you have some really, really like detailed, granular decimal points, but that misses the whole point. Like you're not actually being more accurate. I mean, in essence, it is completely fine to just leave it if you don't have any support for it in your narrative. So I just want to highlight that.
No, of course. And then again, for people that may be joining us right now, all of this does not include any ads impact. So I assume
yes. So this is the
once we
current
actually
business.
so I assume once we actually get some traction or maybe some numbers from the company around the ads business, probably next year, things might change here, margin wise, for sure.
Yes.
Talking about ads, since this is still early days, since we just talked about all the data that they have, some people did post already a couple of things that they've seen in the PayPal app, in the Venmo app in the United States. Some big companies actually already promoting stuff on Venmo and on PayPal. How big do you think this thing might get? Because again, we're talking here about a huge amount of data that they've been collecting for a long period of time. It's a worldwide company working with probably worldwide customers. How big does an ads business for PayPal become in the future? And Uber, for example, is at $1.5 billion in ARR, growing 60%. This is not Uber, of course, it's PayPal.
The Lego pieces are there, to build something great. And in essence, as I mentioned, essentially they have the most accurate and best data suitable for an ads business out of anyone today. Like they just power so many of the online transactions that exist and store so much data that they do have the potential to be like the number one ads business, like above Google, above Meta, like those huge players. The problem is, I'm not overly excited about some in-app advertisements. I mean, that's a start. Like they're starting to roll something out, and I even believe that they have some, third-party ad slots where you can see like, oh, there's an offer for you, pay with PayPal, whatever. Check out the what I envision, and they haven't confirmed this, so this is just what I envision for PayPal. And the reason I didn't include it in my model is because it is intangible, like it does not exist today. I don't know if it will exist, but here's what I imagine. Okay, imagine you go to Nike.com, or you go to whatever website you like shopping at, and the merchant is connected to PayPal, which there are over 400 million merchants connected to the PayPal platform. They know your history across all the other merchants. And instead of having, a plain website where they list their products, they already show you on the landing page everything that is highly likely to be of interest to you. That to me is like the essence of a powerful ads business, where, because it does not appear to be an ad. It's not something where you have to like where you're like browsing news and then something appears to the side. No, this is actually like powering sales. Like this is actually leading to sales. It is beneficial to you as the customer because you are immediately presented with what is highly likely to be of interest to you. Like, oh, these are the kind of shoes I've been buying, these are the kind of shoes that I'm interested in, already presented to you immediately. So it's saving you time. It is saving the merchant time, because I mean they will have higher sales, so they are benefiting, and PayPal is benefiting. So I envision this kind of like flywheel where everyone is happy, like everyone benefits, and that is extremely valuable, and it does not exist today. This kind of predictive I don't know if ads is the correct term, but like presenting you with their catalog of products that is likely to be of interest to you, I think that will be really big. And I think like PayPal can be can grow to be a very large business if something like that were to happen. So personally, I don't know if that will happen. That is what I envision. I mean, they've talked about it, in investor days, how big the vault is, what kind of data, what kind of stuff they could be doing, but they've not actually confirmed that such a product is in development. But that's what I envision as like the ultimate bull thesis for PayPal ads. Now, it is simply an idea of mine, a wish of mine, and that's why I didn't include it in my valuation model. I don't want to assign value to something that is just hypothetical. So it is completely intangible today. So that's why I don't include any value from it.
No, fair enough. Fair enough. I mean, to your defense, it's not like they've been talking about it that much, right? They've talked a little bit here and there, ads, maybe some posts. But I do think that maybe 2026 is when they'll give us a little bit more
Yeah.
information
So
on it.
just to clarify, when they do actually start reporting numbers on ads, the ones that actually exist today, as we mentioned, like in-app off-site ads, I will of course model that in. So that's not what I'm saying, that I'm gonna ignore ads until my dream scenario happens. So of course I will model that in and assign it value. So even what they have today will increase the price of PayPal. But I think still the core investment thesis for me as of right now is that even the current business is just so disregarded that you have a double in the stock, even like they just keep doing what they're doing now. Like it is completely insane to me.
Yeah. Going forward, we've talked about ads. PayPal World is also something that we still have to see how that evolves over time. Another aspect is, of course, the rise of the use of stable coins, right? And
Yeah.
how that could help PayPal as a business. What's your view on it, if you have a view on it?
Okay, so I'm not known to be a crypto guy. I think Roy Crossroads is very interested in that aspect of the business, and you might be as well. But it is clear to me that just seeing recent regulation changes where the US administration is a lot more open to crypto in general and are starting to adopt, stable coins. We're starting to see more and more institutions start to open up to it. I think it will be part of, the future of finance. And I think that PayPal is already, preparing for that next leg up in tech. It will solve a lot of FX problems that PayPal is currently experiencing. As of how it can be leveraged, further, I'm not entirely sure. I didn't spend too much time on it. It is still fairly new. I probably should look into that a lot more, but I'm very curious about what you are seeing, from the stablecoin part of the business and how that can actually help empower other parts of the PayPal ecosystem.
Well, I'm not seeing much other than Roy's posts recently
Yeah.
on stablecoins because he's
So,
following that much closer than I am. I have seen that the PayUSD market cap has doubled, I think, this year. It can help with faster payments, cheaper payments as well. Um,
yeah,
Maybe some
settlement and
higher
stuff like that.
margins. Yeah. So it can help on that side. And then as for the rest, I guess I'll leave that up to the company to figure out how to best make use of that technology. Um, and Matthew, I see your comments. We did touch on that specific aspect of PayPal might not be viewed that positively in the United States, but it's not just about the PayPal.com aspect of the business. It's about the payments that happen behind a lot of systems that you don't see that is using PayPal's processing, plus Venmo, which I think is very much loved in the United States, because I mean it's only in the United States. What was crazy to me was that PayPal and Venmo never talked with each other as systems. To me, that was
Yeah.
insane, insane. Um, huge, huge mistake, of course, from the previous management. Which, by the way, previous CEO Dan Schulman is now current Verizon
I
CEO.
saw that. Oh, Verizon. I thought it was AT&T, but yeah. Anyway, one of those, and I saw the stock dropped like 9% on the news. People were not happy about that. To be fair, I didn't hate Dan. I think he did a great job, initially, because all the way, actually, a lot of people don't know this, but um, Adyen has been around since 2013. Stripe has been around since 2013. Apple Pay has been around since 2013. Google Pay has been around since 2013. PayPal actually gained market share every year until 2022, I believe. Up until 2022, from 2013, they actually kept gaining market share, even though all of these competitors were competing. So, I mean, Dan Schulman is not useless as a CEO. He lacked execution in his final years, but I mean, he made a good business out of PayPal, the core PayPal business. But when they started, I don't know if it was pressure from the board. I know that we have some activist investors entering PayPal. I don't know how much that screwed up. Most famously, perhaps Terry Smith. Are you familiar with that super investor?
Yep.
He went into PayPal and started demanding changes. So when you have all of these things happen, it is very easy to lose course. So I don't know how much is down to him specifically, how much is board demands. Management system, the management team, not system, sorry, has obviously been replaced. So obviously there were bad apples in there. It's been cleaned up. So now it's up to the new management to start to execute. And if you look at the hires that PayPal has been doing, these are some very, very well respected hires in their respective industries. As you mentioned, like we have the Uber ads guy joining, like most of the new recruitment to the C-suite and management team, they are like very well respected. So it will take time to build a new culture at something that obviously wasn't very healthy. As you mentioned, core product teams not even talking to each other. There's no integration, no ecosystem, no nothing. So that obviously will take time. We have given Alex Chris a lot of time now. I mean, what is it, like this
2 years.
quarter it will be 2 years, yeah. And I think actually now 2 years in, we're actually going to start to see some improvements, like actually tangible improvements. We're already seeing Venmo accelerate its growth rate. We're already seeing like a new structure being formed. The numbers will start to come in from now, is what I believe. So but in any case, the stock is just so extremely cheap and undervalued. Like when you have those both combined, and as we see here in this chart, I mean, if the stock doesn't really have much room to move down, because PayPal generates so much cash flow that they are like fully committing towards buybacks. So let's say that they do $6 billion in buybacks, that is like completely from the free cash flow.
Mhm.
If the stock stays at these levels, they will have repurchased like all outstanding shares by 2031. This is like 5.5 years out. Like that is completely insane. Like even if the stock does nothing, just stay still for 5.5 years, they will simply have taken the company private from repurchases. Like they are just making so much, they're generating so much cash that this makes no sense to me. And I think people will look back at this as like one of those, oh, I should have got an in trade, like the one of the obvious ones. It's easy,
Mhm.
you know, in hindsight. But even like Palantir, I'm not saying PayPal is Palantir, completely different businesses. I think Palantir is like a monster machine of like something that the stock market will not see like probably ever, or it will take a long time before we see the next Palantir. But Palantir, just as a reference, also traded sideways for a prolonged time before we actually started to see the stock accelerate. And by the time it started happening, people were like, oh, I should have gotten into Palantir. Like PayPal is even more obvious than Palantir. Palantir had a lot of question marks back then.
Mhm.
Like there were, as many people mentioned, no one understood the software, the technology. They were upset with management. They had bad PR. Like Palantir had a lot of things against them, and still people got into Palantir. PayPal, I mean, it's open there for everyone. Everyone can see how cheap this is. So I think this will be one of the most missed plays, like in at least this decade, where people are like looking at it like, nah, PayPal is not for me. PayPal is just trading sideways. It will keep doing that forever. I believe that it will. I jokingly, you know, when I met Amit a couple of weeks back, I jokingly said that I think it will double in the next 2 quarters, which is funny because I never predict price. But
Mhm.
I mean, it's just so ridiculous that I just can't believe that we still have an opportunity to get into this stock at this price.
Well, I do hope that your predictions happens because my options will be uh, up a lot if that happens.
Yeah.
Before moving to SoFi, one last thing. Where is it? This one, because I have a question about the upcoming quarter, Q3. Any things that you are looking at specifically for the upcoming quarters? Any things that you're yet maybe transactional margins here? Any other things that you're like, this should already improve in Q3 or maybe in the guidance for Q4?
You know, the main thing to look at right now is they break out you know, their payment volumes by segment now,
Hmm.
and actually seeing the, you know, the focus areas actually start to accelerate meaningfully. I think that's the single most important part. Margins will of course take some time where they can actually start to meaningfully increase it. If it is like 47-48%, like 1% different, it's not the biggest thing, but actually seeing that re-acceleration, I think, is the number one thing. And also account activity. I think I have a chart there where you can see
Yes, you have.
yeah.
You
So
have it.
here's one of them. So this shows you how many payment transactions each active account is doing on PayPal. And as you can see, since 2014, it is going up. So back then, on average, one account made 26 payment transactions per year, that is up to 61. So seeing something like the amount that people spend using PayPal and the amount of transactions, both of those I hope will go. Yeah, here we see the average payment value per transaction. So I'm expecting this to go up as well. So account activity and also the volume growth in focus areas, more specifically Venmo, and also if we can see some Braintree acceleration as well. I think those are my focus points. I don't care too much if transaction margin dollars are up 1 or 2%. It's not the biggest deal as of right now, like on a quarter-to-quarter basis. It is, of course, more important on an annual basis, but for now, I just want to see some life in the segmented stuff. That's what I'm looking at. How about
No,
you?
fair enough. I mean, for me, we know Venmo from the recent comments in analyst conferences that Venmo is growing quite rapidly.
Yeah.
I think Braintree is the one where we'd all like to see reaccelerating growth, right? By design, they've slowed it down to focus more on well, the profitability side of it. But yeah, Q3 could be, although they did warn us of maybe some one-time thing that might impact Q3. Also tariff related stuff that could slow down e-commerce and all of that. But Braintree should start to reaccelerate. And I do think that comments that will be made for guidance for Q4 should again be a good catalyst for bulls in this case. The buy now pay later side of the business is also, according to them, which they maybe I can pull it up. The numbers that they gave us in the last analyst conference were also huge if we compare them to the firms of the bunch. So the buy now pay later business for the company is also something that I think flies under the radar a little bit. Let's see if I can find the exact number they said. But yeah, I
That's
think
a nice thing with these financials is that there are so many conferences like Goldman Sachs, Morgan Stanley, all of these guys host conferences. So if you're following something like Palantir, you're hoping that Alex Karp will speak somewhere and you can get some hints. But these guys actually have a lot of stuff happening each quarter when you can actually get some hard hitting questions, putting management to the wall where you can actually start to extract some value. So it is definitely worth listening to. In terms of PayPal, I've actually not listened to the more recent ones, so I don't know exactly which comment you're referring to.
So I will tell you. The buy now pay
Tell
later
us.
business. Tell us. No, but most of the listeners already know because I've repeated this. But anyways, the buy now pay later business did generate $30 billion in TPV last year, and that's growing above 20%. It's being strategically moved upstream in the checkout flow to act as a customer acquisition tool, catering to a younger, credit-averse demographic. So growing quite quickly. If anyone has any questions about PayPal, you can let us know in the chat. Moving on to another company that's moving quite quickly, and this is available actually for free.
Yes.
On your Substack, and you can find it on X as well. So SoFi Technologies, and this is a very recent one. So the numbers here are still up to date. Well, very much up to date, actually. You saw a fair value here of $32. Back then, that was a 25% upside. I think right now maybe it might be a little bit less or so, but doesn't matter.
Just open the PDF from the top. I think better. Go up. There.
Correct.
I think this might be better just for viewing. So this was a commission on my website where a guy actually paid me and said, oh, yeah, I want to report on SoFi. I've never covered SoFi before. I know that it is a very, very popular stock with, the retail community. I know there's a lot of following. So I said, sure. Well, I typically don't say no. But I looked at SoFi and I purposefully ignored everything because there's such a strong retail community. There's a lot of due diligence being shared, a lot of research being shared frequently on platforms like X and other communities. So I ignored all of that and went into it blindly to see, okay, what can I find here. So we have a question first
For you, yeah. He
Fiscal
asks,
AI unlevered free cash flow for PayPal for 2024 is 3.7 million. How do you explain the difference with the in the model for 20? Probably because I add back stock-based compensation, which typically unlevered free cash flow model will not do. So the difference here is that I actually model in dilution from SPC. Because SPC is not a cash expense. Like they're not expending cash. So that's why I think it's important to add it back. But I think it's also even more important to account for the dilution that happens. So what I do is I do it on a per share basis where I expand the shares outstanding every year, which a typical, unlevered free cash flow model will not do, or free cash flow to the firm model will not typically do that. So they just ignore SPC as a whole. But because I account for it, I add back stock-based compensation. So that's probably why there's a difference. I haven't looked at how they calculate it, but if I had to guess what the difference is there, it's probably, well, no, it's 1.3 billion. I don't know. I would have to look at it exactly to see what the difference is. I don't know on top of my mind, but here's my suggestion: calculate it by hand yourself and see what you arrive at, and then you can see if I'm wrong or if Fiscal AI is wrong. I can tell you by experience that most automatically generated models are very poorly done. So my recommendation: calculate it yourself is my recommendation there.
to answer this question, rewind 20 minutes back, and I think we've talked about that a little bit.
Yeah.
So SoFi.
Yeah. So I kind of went into this the way I go into like Tesla, where you're gonna be hated from both sides because it is kind of what would you call polarizing stock, where you have these hyper bulls and hyper bears. So if you're somewhere in the middle, you're gonna be hated because for example, here I have 25% upside to fair value. The bears will say, "Oh, you have no idea, they're worth a lot less," and then the hyper bulls will say like, "Oh, that is way too low. Like it should be like 150% to fair value." So it is kind of like that, but not to the same extent as Tesla. I think even the couch investor, when I showed him this, is like, "Dude, your numbers are way too low, man." I'm like, I don't know. That's what I'm seeing. So I purposefully ignored everything that other people had to say about SoFi. And only after I was done did I ask people for their opinion, some very, very deep into the community SoFi guys, data-driven investing, for example. Roy, as we mentioned with PayPal, is also very big on SoFi. So asked a lot of people for their, okay, did I get the story right or did I completely miss it? And it seems that I captured most of it, is my general impression. But yeah, very, very high quality business overall.
You
so
did,
yeah, take
you
it
did
away.
say something interesting. One was this: the financial services products per member that have been staying flat for
Yes.
a while, and
So
that
yeah, sorry.
no, and that should change, right? Well,
So
according to the bulls, it should change.
this is the biggest red flag with SoFi. So you can see this from two angles, right? So this chart here shows you how many financial services products each member has adopted on average. And it is at 1.3. And as you can see, it's been at 1.3 for a very long time. Like it is stayed stagnant for like 3 years, right? And during that time, SoFi has launched a lot of products, SoFi Wallet, SoFi whatever. The bigger problem here is that 1/3 of all the financial services products is SoFi Relay. That is not a revenue driver. It simply shows you like the account balance from your other bank in the SoFi app. So Relay is 1/3 of all financial services products. So already there, that is a red flag because that does not drive revenue. That does not drive anything, basically. And then you have this, where people are only adopting 1.3 products on average for like the past 3 years. And during these past 3 years, SoFi has been doing a lot in launching new products, but people are not adopting them. So Relay was meant as like the gateway, right? You get SoFi Relay, you can start to see your account balances. That will make you spend more time in the app and more opportunities for you to discover more SoFi products and actually start to, adopt more and more. Like maybe you start to bank with SoFi, maybe you start to invest with SoFi, maybe you start to use their AI services and stuff like that. But it's not happening. So you can see this from two ways. One, SoFi is growing incredibly impressively, even though the thesis is not playing out. So when the thesis actually starts to play out, the growth will be insane for SoFi. So that is one, like the bullish way to see it. Like they're actually growing insanely well, even though the thesis is not playing out. So when it starts to play out, it's going to be even more insane. The other side is the products are simply not attractive and it won't play out. So those are the two angles. You can decide where on which side of that fence you are, but that's the dynamic happening. So this is one of the major red flags for me. If Relay was not 1/3 of all the financial services products, I wouldn't be as worried, but because it is such a huge percent, I'm kind of iffy about it. I'm not very confident about that.
Okay. First up, again, happy birthday, Roberto, and thanks you for a super chat.
Wow.
He also became a member of Emir Substack. And
really? Thank
yes,
you.
That's what he says. He would appreciate if at the end Emir could touch on his FICO thesis.
Let's go, FICO.
I don't know if we will have time for a FICO today, but we are definitely going to talk more about FICO and SPGI in future episodes. For sure.
I should just do a video on FICO. So go follow the YouTube channel. It's gonna be something.
Voila, even better. Another thing, and this is basically what you're showing, right? With the
yeah.
relay
So
being...
if you the golden one is Relay, and money is another third, and then you have a third being Relay, and then the rest is kind of like spread out. So you have the invest, credit card at work, and referred loans. So Relay being such a huge part could be a red flag if it doesn't start converting into more cross-selling. So you should definitely look out for that.
Would you say that the loan platform business, which of course is a higher margin, lower risk, fee-based type of revenue, which I know you like,
yes,
would you say that if this thing continues to grow and ramp and become a bigger chunk of the overall revenue and profits, would that balance out or even become even better as a risk reward type of your threat type of thing if the number still stays at 1.3 products per member? I think it can grow, but if the other side of the business, which is again a very fast growing side of the business, if that just continues to grow exponentially, does it matter?
I think that's actually what you're seeing right now, because the financial services segment is just recently actually starting to be positive margins. So the loan segment has carried SoFi's business like almost forever. Like even like the tech platform is not contributing, the financial services segment is not contributing. So essentially SoFi has been carried like by the loan segment of the business, almost completely. And that's what's happening now. So that is nice in a sense, because it doesn't put pressure on you to make rash decisions that might actually hurt SoFi in the long term if you prioritize near term results. Instead, it allows you time to build out a proper strategy. So I think that's what you're seeing now. So it doesn't matter too much as long as the loan segment performs as good as it has been doing. And I think even the loan segment, it's like, when I cross-reference it with like every other similar business and even to the major banks, SoFi is outperforming on like most metrics, on charge-offs, on delinquencies. SoFi has extremely extremely good customers on the loan side. They're like 0.07%
Yeah, that's
delinquencies
what I'm
across
trying to
all
find.
segments.
Do you remember
It
what
is,
page?
yeah. Go up to the FICO chart. Here, yeah, here. Go down. Yeah, there.
Here.
So, as I mentioned here, FICO across all segments, they own, like, they're essentially like super prime, like their lenders are like in the super prime segment. So
Mm-hmm.
they have 0.07% delinquencies as of Q2 in 2025. Banks, like big banks, have 0.5% for mortgages and 1.5 to 2% for personal loans. Like SoFi could have 5x the delinquencies and they would still like outperform the banks. And why is that important? Because lower delinquency rates implies that you are being overly conservative. So of course, when you have a lower FICO score, the terms of getting a loan will be slightly worse, which means that SoFi takes on a bit more risk, but they get a lot more revenue from you. So when you have these like prime lenders, the revenue is actually not as good as if you would be taking more risk. SoFi is taking like no risk at all. Like 0.07% is like extremely low. Like they could be like 5x the risk and they would still be like considered like, yeah, this is a safe bank. Like they are for personal loans, like at 2%, on average, they could like 20x their risk and make like so much more revenue if they weren't so overly conservative. So that's also an interesting aspect. So despite that, they are still growing really good while being extremely safe on their loan side of the business, which is really, really impressive to me. I've not seen anything that is quite as good as SoFi in that specific regard, but I would like to see a more balanced approach there. You just for revenue purposes.
My question, and I'll make this a post and tag Anthony Note, although I don't think he will be able to answer until the earnings report, or hopefully he can say something, I don't know, during the call. But why do you think it is so low? Of course, it represents a lot of upside for the business, but why is it so low? I would have understood if it's a little bit lower, right? Because you're still small, maybe you want to prove yourself or whatever. But why so much margin for error?
I think I read some comments actually from management. They kind of pride themselves in this, that they are like seen as incredibly stable and credible. I don't think they see it as a lost opportunity the way that I frame it. I think they're seeing it like, oh, look what we have achieved. So I think they view it from the other lens. But as an investor that just wants to maximize, shareholder value, to myself, if I would have owned SoFi, is that I would have liked to see some more risk in the asset book in general, because it's not only the delinquency rates. The charge-off ratios are generally lower, and that translates to, okay, how much yield does SoFi get out of the assets that they do? So that translates like throughout the whole business. So I don't know actually what the reason is, more than that maybe they want to be perceived as like a very, very safe bank while they're still growing. Because when you look at assets under management, they're not a large bank yet. They're not a
Hmm.
big bank. So as you are, up and coming, maybe this is more important to portray outwards that, look, our customers are like really, really, really solid, like super prime, like. So maybe that's why. Maybe I am, not understanding this kind of business enough where I can, understand their true purpose. But if I had to guess, then maybe that's why, considering that they actually brag about this in their like investor presentations and stuff like that. So I'm not sure myself.
No, I mean that would be a good question to ask, I guess,
Yeah,
management and get maybe an answer there. But
I think if you were done on that segment, I think the chart above is also an interesting one.
this one,
Yes. So I think I don't know. Is there some beef between the SoFi and Hood communities? I'm not
made
sure.
up beef.
Yeah.
It's
Okay.
good for clicks, I guess, on X, but it's just I don't know. I laugh at it because everyone's making money. So what's the point?
Yeah. So I can tell you that the customer acquisition cost for a SoFi customer is about 6 times as much as a Robinhood member, and scaling revenue per member is a lot easier than decreasing customer acquisition cost. So while SoFi still has, uh, what I would say like a good dynamic, because as you can see here, this is like on a quarterly basis, each member makes more every quarter than the customer acquisition cost, which implies that every new member is paid for within the same quarter, which is a
Hmm.
good dynamic. If it's like the opposite, where they're like overpaying to getting members but the members are not producing revenue, that would be a huge red flag. So as long as you see something like this, where in general the revenue per member is higher than the customer acquisition cost, that is good, because that scales, right? You only need to acquire the customer once, and then you can like calculate the lifetime value of that customer. But it is more than one quarter in general. So this is good. But when I look at something like Robinhood that spends typically something like $50, and they get something like $180 revenue per member, I think it just shows that SoFi has a lot more of a difficult time penetrating like into um the acquiring new members compared to Robinhood. And I'm not sure why that is, because I don't live in the US. I can't really try the product myself, so I can't really see like, okay, what advertisements am I being hit with from
Like
both
I can
platforms.
make
So,
assumptions,
yeah.
right? Robinhood was the, let's say, first big commission-free trading platform that offered stocks, crypto for their benefit or not. They had that huge scandal a couple of years ago with GameStop. So again, it became the name out there. Back then, it might have been bad for the brand, but the name Robinhood became a worldwide known name. SoFi
Yeah.
does not have that brand recognition just yet. Um,
So
it's
that
also
would
not
make
viewed as a
sense.
platform to invest just yet either.
Yeah, I'm not talking about like investment, because the reason why this is interesting is because Robinhood is starting to scale out into the same
Hmm.
segments that SoFi operates in. So this will become like a actual comparison to be made. But even prior to like the 2021 stuff, Robinhood wasn't paying. If we go and look at SoFi, they weren't paying over $500 per customer acquisition. So I still think this is fine, but this is something to track. As you can see, the margins aren't big, and I can assume that SoFi will start to advertise a lot more as they start to build out their ecosystem. But this is a key thing to track. Like, this should, if the products are good, this should naturally over time start to build a gap, as we are seeing with
Hmm.
Robinhood. Robinhood also used to have this narrow gap between the customer acquisition cost and revenue per member. But as the products are seen as more um, attractive, they start to like gap up. So if SoFi's product portfolio is actually attractive, you should start to see this over the coming quarters, that they actually start to separate a bit, where the revenue per member is increasingly more than the customer acquisition cost, because now it is neck and neck, but still on average it's not like a bad dynamic here, but it is interesting to track for investors. I think this is worth keeping in mind. But overall, on SoFi, I think everything that I could find is that it is a high quality business. If I could only own the loan segment and ignore the other parts, I might have invested in SoFi. For now, I'm still on the sidelines. I want to see more product adoption. I want to see more cross-selling before I'm completely sold on SoFi. But for now, still on the sidelines. But I can say that this is a high-quality business that is currently undervalued still.
Fair enough. I mean, talking again about the maybe some comparisons that can be made. SoFi was, of course, pushed out of their crypto business that they had before. Could have helped them attract more users for less if they still had, maybe, I don't know. But it will be coming back. Options are now live on the platform, so I guess that's another added value. I don't know how many of the SoFi members as a whole really need options on the platform, but
Crypto
again, it's
is
added.
back too, right?
I don't think I don't think they've made the announcement already, but it
Okay.
is coming back. So those are little things that could, of course, help, because if you have everything in one platform, why would you leave to somewhere else? But yeah, it's an interesting story. I am very happy that the loan platform business became a thing, and because that truly, for the last year and a half or so, that thing just changed the business a lot, I would say.
Yeah.
To go to your model, and I do want to say thank you to SJ here. Thank you for the super chat. Emir and Couch collab should do live more like a few months back, well, maybe a few months in the future, but we will do more. CoreWeave is an interesting one. We do have other companies who would like to cover first, but who knows? Maybe one day we will talk about CoreWeave. I am surprised you have not gotten any request to write about one of these huge huge AI names, CoreWeaves, Nebius, etc., etc. But maybe it's an
Well,
opportunity for some people to.
it is a very expensive and niche product, and to be honest, it's not really okay. So I'm gonna be honest here for couch investors crowd. Even if you order that, I'm not really excited to write them because they take so much time that it's not even worth it. Even though the price is obviously very high, I think it's like $1,200 right now. It's not even worth it for me because it takes like over 100 hours. So when you like break it out, I'm like being paid like $3 to $4 per hour to write that report. So even though it is like a big chunk, I'm not that excited to write them actually. But yeah, that is available if you want me to do something like I did with SoFi here. Obviously, this is a good sample of like what you get when you order an equity research report, and in addition to this, you get the Excel sheet as well, where I agree. So that is what takes the most time. I'm gonna be honest. Out of like 110 hours for SoFi, 80 to 90 hours was just like the Excel sheet, because I go back to the S1 filing, I fill out like all the historical data before I even start analyzing the business. So that's like the biggest time consuming thing and aspect to it. But you get that for free. And I think the Excel sheet I put out for SoFi, it is available on my Substack. I think it's the number one like resource for SoFi data. Even institutionals don't have as good data as that Excel sheet. So that's a treat for all the Substack subscribers. He can grab that. But yeah, if you're interested in having me write a equity research report for you in style with what I did for SoFi here, you can go to typefcapital.com. And if you're interested in the Substack, it's research.typefcapital.com. So that was my advertisement slot. Thank you, Couch, for giving me a platform to advertise myself.
My pleasure. My pleasure. If someone wants any ideas, ask him about Mercado Libre. He would love to write something about
Yes, Dilo or Mercado Libre. I'm very interested in those.
it. Here you
Yes.
go. The local Mercado Libre. Whoever wants a report, the link is in the description. How long does it take you to do this? 100 hours usually
Well, it depends on the
of
business, of
work.
course. Yeah, or more than 100 typically. So that's why I'm not, very hyped about it. So I would rather just, focus on publishing on Substack. But in this case, the customer said, "I want you to release this for free," which is
Mhm.
obviously great for the community that wants this. So that's why I put it out here for free for everyone. So this whole PDF is free. You can go and grab it on my Substack. You don't have to subscribe to anything. You can grab it. You can read it. What was I about to say? What did you
You
ask
weren't
before
about
that?
to say anything.
Oh.
First of all, surely, thank you for a super chat. Great analysis. This is the fundamental numbers I look for, even as a YOLO option trader. As long as you make money, as long as we make money, we're all very happy. Now, I was about to ask you, so that people know, are there in your Substack there is a specific list of companies that you do write about?
Okay, so I have a set list of companies that I cover every quarter. Similar to like a Wall Street firm that they will like update it each quarter with a new, price target. In my case, it is a new fair value. So that is a set list that can, keep increasing or decrease depending on what I'm interested in right now. But I also put out, one-off equity research report. For example, I did
Can I show
Constellation
just the main
software. I did.
page?
Yeah, you can go show the main page. So, man, he's really doing me a favor here. So, if you go down slightly here we have the company research coverage. This is where I cover everything on a quarterly basis. I update my fair values. I give my updated takes on the companies. So there's something like S&P Global, FICO. I just added Formula One group because I want to track it. So I have a bunch of companies there that I will keep track. But if you go down just slightly here, I have this with a blue background, and these are one-off pieces, and these are mostly free. So the ones above, I think like I make it like 50-60% are free, and then for the last part you need to be a
Mhm.
subscriber, but these are mostly free. So like the Constellation software one, I just covered like as a one-off because I wanted to. Then you have the SoFi one now, and so yeah. And then in addition to that, I have the thematic portfolios where I build like a portfolio based on different themes. So I have like an AI team, a financial team, energy team. All of these are beating the S&P 500 since inception, which is nothing to brag about because I just started my Substack. And then I also share my personal portfolio every update. I think I had one yesterday. I'm going to post one just after the show of my new buys today. Um, and the final part, which a lot of people like, is that I post downloads to all my models for the subscribers. And I think we're soon up to like 20 different companies where I have. So the intrinsic valuations there's a download link to. Don't click that. You're gonna
I'm
reveal
not
the link.
clicking anything. I'm
Yeah.
not gonna.
So there, I update that every month. I keep adding to, as soon as I value a business, I add it there, and you can go and download it and look at it. So all my valuations are available there. So that's my whole Substack in one go.
Okay. Voila. For those that were interested, here it is.
Man, I feel
Um,
so dirty. Feel like Meet Kevin, having to
no. Let's not compare ourselves like that, please, please.
I have this
um,
coupon code. No, I'm just kidding. Okay, the model. Okay, we're looking at SoFi here.
yeah,
Yes.
the model for SoFi is a bit different than the PayPal one. There are
Yes.
a lot more lines here.
Yeah, because the way they make money is fundamentally different. So each model will, of course, be specific to the company, and you have to capture the dynamics of that company. That's why no model is the same. So typically, I like to break it out into segments because it allows you to actually model out the story for the business for like each segment, instead of just bundling it all together. Like you don't get that granular detail. So that's why I like to do it this way.
Okay.
So yeah, more lines in this one. It doesn't mean that there is more or less detail than the PayPal one, which is shorter. It's just like different dynamics to capture.
One thing I did notice is that you have share dilution at, well, it's still at 10% right now. It goes down 98875 and then stays at 5. Quite a high
Yeah,
number, no?
yeah, that is very high dilution, especially considering that they are actually becoming increasingly more profitable now, where they don't have to equity raise. So this will likely change as of Q3 as I get some more like data and some more insight. But for now, I have extremely high dilution. Like even 10 years out, I have them doing 5% because
Mm-hmm.
I don't completely understand the uh, cash needs properly, or how much dilution they will have to do in the short time that I had to look. So I would rather be on the conservative side and modeling a lot more dilution than the opposite, where I'm like underestimating dilution from the company. So that's the reason there. But yeah, it is very high. Yeah.
Okay. Then you you told me something about the non-interest income, and then no, the net interest income and the non-interest income, right? You would like to see one actually go up a bit faster than what it has gone up prior to some of the periods right here. I assume it was the non-interest income
I
part.
don't remember exactly the comment, but what's the interesting dynamic here is that of course you have the loan segment and the assets that are farming yield in the interest part of this, and then you have the non-interest part, which is like the financial products, this
Technology
technology
products. Yeah.
platform. Luckily, this segment is recently saved by the loan platform business, the
Mm-hmm.
LPB, which is growing insanely fast. So that is kind of saving this whole segment. Without that, this would be a very, very sad outlook for non-interest income. That's what I said. Like, if I could just own the interest part of this business, I would have bought it. But since they have two weak parts of the business in the non-interest segment, the tech platform, the AWS of
Fintech.
banking,
Yeah.
of fintech, it's not really playing out. Commentary about it is becoming muted. Even bulls are saying, well, they acquired Technisys and Galileo primarily for themselves. Any additional revenue is just a bonus. So there's a lot of like muted comments about that whole investment thesis that was very popular a year ago. Everyone was talking about the AWS of fintech, but that is not playing out. So that's why I have very modest build out there, but I do have it accelerating into later years because even SoFi themselves did not fully integrate Galileo and Technisys. They're expected to be complete by next year.
Yeah.
So that will probably lead to accelerated product rollout themselves, because they're still using legacy systems. So it's not that easy to integrate and launch products and stuff like that, as long as they have parts of their business on a legacy platform. But that also just goes to show like how sticky these legacy systems are, especially within banking. It is very difficult to go in and disrupt that, but you have to start with yourself. You have to show how much value you can extract from actually using all these APIs and stuff, how quickly you can roll out products. When you prove the value in a couple of years out, that's when I think that the tech platform will actually start to have some meaningful growth. That's why I have the later periods here actually start to pick up. And the financial services products, I'm not overly optimistic on that contribution, as long as we don't see more cross-selling start to happen. So
Mm-hmm.
when you do a model, you do it at what you're seeing right now and what narrative you can tell right now. And I'm not seeing any evidence that cross-selling will actually start to happen meaningfully. If by next quarter that completely changes, then yeah, this model could be a lot more optimistic. But as of right now, this is what I'm seeing. So I'm not seeing too much happening there. But the most important part is here: when does it become operationally profitable? Because even though SoFi is net profitable, it is mainly due to how it is being accounted for. But the non-interest segment is not profitable. It is very highly unprofitable actually. So I have it somewhere 2028 is when I expect to break even. But still, I don't expect this to be a high margin segment for quite a while. That's what I'm seeing currently. Yeah. So that is very, very important to driving intrinsic value, is when can this actually start to become profitable, and then how profitable can it be? Those are the key parts of the model here.
This was something that was mentioned a couple of times. You were quite happy that you actually made a DCF and looked at SoFi from a free cash flows perspective, right? Because a lot of times you hear
It
that
is
you cannot do it.
actually, even the goat himself, Aswat Damodaran, recommends that you don't do free cash flow to the firm models for financials like banks, because the problem with them is that they have operating assets, and that is subject to fair value adjustments. So you could have like 1 year show up as 180% free cash flow to the firm margin, and then you have the next one negative 300%, like, because and without any cash actually being exchanged. So you have this problem where you have assets, and one input in one of these models, a core input, is actually working capital. So you look at how much working capital is required in the whole reinvestment part of the business. So that's why people typically say that free cash flow is useless for businesses like SoFi. I'm like, no, it's not useless actually, because SoFi generates cash, and you can actually find a way to adjust for it, where you actually capture, okay, how much cash are they actually generating? But there's not a lot of visibility in the banking industry in general. So that's why people prefer to use book value, or prefer to use something more simple like PE ratios, or stuff like that. But me, going back 4, 5, 600 years, people have bought and sold businesses based on growth, cash flows, and risk. So that's why I want to find a way to adopt it for even this kind of business. And I still believe that every kind of business can be valued using a free cash flow to the firm model. So what I did here is I looked at the risk-based capital ratio that SoFi has. So this is there are regulations, how much regulatory capital is required. So I use that as a substitute for working capital. So that's how I got around to this. And even here, SoFi sets aside way more regulatory capital than needed. So they need 10.5%. They set aside 16.2 as of 2024. So even here they're like overly conservative by like 6% basically. So throughout every part of the business, they are just overly cautious, overly conservative, where they could actually be translating that into more revenue, but they're not. So yeah, that's how I got around to it and managed to actually value SoFi using free cash flow to the firm. And
you actually have them grow quite rapidly, going in 2026 already. You have free cash flow margin go from 2.8 to 19%, and then in the 30s.
Yeah, so a lot of that is I should make a more detailed video where I explicitly explain this, because as you can see in the operating income, there's a huge jump there. So there are different kind of dynamics where you have to look into the provisioning for losses, how going from negative 42% to negative 22%, how much that actually impacts the net income. So this is actually not a lot happening from the net interest income side. This is like the non-interest side. Just shows you how big impact, because this is a lot of revenue that has to translate to operating income. So even halving like that is a huge jump, but you don't realize it because it is negative. So going from negative 44 to negative 20, that's a huge jump actually in margin. So that's why you see this whole dynamic change here, and that's why there's a huge jump in free cash flow to the firm margin. But yeah, I should make a detailed video because it actually normalizes after that. Even though they keep improving the overall margins, it stabilizes and normalizes around that 30 to 35% range.
Okay, you see, now you have already two video ideas. one FICO and one SoFi explanation.
And here's another interesting one. You can see I have total tax at 0 for this year. That's obviously not going to happen. But the way, they have accumulated losses where they can, play with tax for around 1.5 billion before they actually have to start, tax their income. So I just make the assumption, even though that's not reality, they're not going to be at 0 for tax expenses this year. But that's another dynamic. So there's a lot of things you need to keep in mind when you do these kind of models. But I put it out there for people that are interested. I also have a download to it and stuff like that. I put out the Excel sheet so you can actually look what I did. But most people are just interested in, okay, what is the fair intrinsic value based on what I read in this report? Most people don't really care about each number in the model. Some people are very enthusiastic about that and want to discuss it. But for most people, they just want to read, okay, what is the story for SoFi? What are the revenue drivers? What's going to be the revenue driver in the future? How profitable will they be? What risks are there? Most people only care about those simple things. Most people don't want to dig into, the numbers for in detail like this. So essentially, if you read the report and then you read my fair value, that is just a reflection of the report you read, because all the numbers here are just what you just read but put into numbers.
Yeah,
is a simple way to look at it.
The story, basically.
Yeah, so the story put into numbers is the model. Yeah, a simple way to put it.
Yeah, no, fair enough. The revenue growth for this year, I know some people already touched on this. You've got them growing at 35.4%. I think the company is guiding for 30% growth right now, which was already revised on the upside. I actually agree with you. I said it last week, because if you look at Q1, Q2, and then you see what they need to generate for the whole year, it's basically like Q3 and Q4 won't even grow that much, which again, I don't see that happening. Again, there is something freaky going on. So I actually do agree with what you're putting here. Maybe in the future, but then again, I don't know what might happen in the future. But I am agreeing with the growth rates that we're seeing here right now, and then we'll see what the upside will be, because next year we should be getting, according to them, some contracts, right, for the tech platform. I don't know how big these contracts are going to be. I mean, the revenue coming in that they didn't recognize in 2025. I don't know who that's going to be, how big these customers are. So that could definitely impact the business quite a lot. Crypto options, how big of an impact that will be on the business, we'll probably only know 12 months from now to actually see the huge impact.
Yeah, because a common counter argument to comparing SoFi Finance to Robinhood is that it's a different kind of investor base. People who use SoFi, they're not interested in day trading or moving positions a lot. They just want to invest for the future. That's how SoFi is set up. It is set up with their advisory AI and their advisory services, where they want you to build wealth through investing, but they're more of that like long-term mindset. So that's the counter argument to why you shouldn't compare Hood and SoFi. But now when you start to add like options, you start to add crypto, how are you gonna make that same argument where like, no, no, these are just long-term investors? No, you're actually inviting to make that direct comparison. So yeah, it's gonna be very interesting to see when that launches in full, to see like what the numbers are actually gonna translate into.
Yeah, the explanation will probably be want to be that one-stop shop. So whatever you want, you'll have on the platform. But yes, then
Yes.
you could not be using the other excuse that's been used before. Quick question for you: prediction markets, is it gambling or not?
Of course it's gambling. Is that even a
'Cause-
question? And I know that Vlad Tanev put out
ah,
some like that. It's not gambling, but yeah, of course it is. But I'm not. I know some people have some strong opinions about gambling. I am very for exploiting, their customers. So if it makes me richer, go ahead, gamble to your heart's content. I'm okay. Of course, that's not a real argument, because what could actually happen is that people that have a lot of assets on, let's say, Robinhood and the Kalshi thing,
mhm.
let's say that they actually have a lot of assets, and Robinhood is making a lot of yield off of those assets, and then they gamble away all those assets, for a net loss, and Robinhood makes like some marginal percentage on those. Like, that is a net negative for Robinhood. So as long as you're a good gambler, go to Robinhood, and keep increasing your assets. If you're a bad gambler, I don't know, go to some other service. I don't know. But yeah, I mean, once we start getting some numbers on it, like actual disclosures, like, okay, this is how much we're making, these are the margins, here's where it's headed, this is what we're thinking long term, then I will actually give it more thought. But for now, I'm fine with it being available to customers. I think it is a risk that people gamble away the assets that they have on the platform. But we'll see how it plays out. I'm not opposed to it. I'm not in favor of it until I see some more, data to. But I'm open to all arguments. But yeah, it is definitely gambling when you're, predicting outcomes that are not like that, have variables out of your control. Then I don't know actually what the definition of gambling is. Like, you can make that, yeah, well, investing in stocks is gambling because it is out of your control. You're just, praying. But then you can say, "Oh, but you made research, blah blah." It is a mess. I don't want to be in any camp. I just want to be in the camp where it makes me money. So I have
Yeah,
you.
but I mean, with the prediction market, it's usually binary outcomes, like it's yes or no,
Yeah,
and there is a
by
specific
specific.
time.
Yeah,
Yeah,
yeah. So by that same, it is similar to all options in that
options.
regard. Yeah. I don't
Um,
know. We'll see. I'll probably try to, this is just on top of my head. I didn't think it through. So maybe this is just incoherent thoughts, but I'm not, overly opposed to it. But I do see some risks with it for Robinhood specifically. And it's gonna be interesting to see if SoFi also follows suit and starts offering, one stop shop, come and gamble away your assets with us. Bet your
no, the
student loan on who the next president is gonna be. I don't know.
the problem is a regulatory issue because gambling is not illegal in all states in the United States. Um,
Hmm.
so
Yeah, I
we'll see
know.
how that evolves because I think there is a lawsuit going on.
Yeah, exactly. I was gonna say that they have probably multiple ones going on, and to my understanding, they've actually been winning the loss. I think they had positive outcomes, but we'll see. We're still early there. It is still relatively low volume, even though it is starting to ramp up like aggressively.
Hmm.
So we'll see. It is an interesting one to track, definitely.
For sure. Last thing here, S&P 500 inclusions. Robinhood
Mm.
recently got in after seeing 1,000 posts for the last 4 quarters or so that this is the day, this is the day, this is the day. Um, you said here that because the S&P 500 is too heavily weighted into financials, this could hinder SoFi's chances.
That was the argument made for Robinhood specifically, where Robinhood, has been eligible for a long time, And for the past, I don't know, before they actually got included, people had been anticipating it. Like every time there was a rebalancing announcement, people were like,
Mhm.
okay, it's Robinhood's time. And then it just kept not happening. So people were like, well, the S&P 500 is overly weighted towards financials. So what the chart here is showing is S&P 500 weightings for the financials segment specifically. So 15% by company count. So if you take the 500 companies in the S&P 500, 15% of those are in the financial segment. And if you take it by market cap instead, 14% are in the financial segment. So the argument for Robinhood was, well, Robinhood can't be admitted unless they drop some financials because the S&P is overly weighted toward financials. In reality, including Robinhood would be like a marginal increase both by count and by market cap. So that is not a real argument is what I'm trying to say here. So SoFi's inclusion wouldn't meaningfully change the distribution of the index. So if you are like scared that, well, maybe SoFi can't be admitted until they drop some other financials, or like, so the balance makes more sense, I can tell you that I looked at the numbers going back to 2016, and it is roughly like, I wouldn't be too worried that that would be a reason. I think the bigger problem for SoFi is, the general accounting, how their net income is calculated, because net interest income, is essentially 100% margin, even though that's not the true reality of it. That's how it's accounted for. And then you have this massively unprofitable non-interest part. So I think the major problem there is actually showing consistent positive margins across all segments for it to be considered for real. So as long as they have massively losing segments, I think it might be tough to get in. But I wouldn't say that the reason they're not getting in is because the S&P 500 is overly weighted towards
Mhm.
financials. So that's what I'm trying to say here.
No, fair enough. Again,
I
I
think
am
by
new.
next year they could probably make it in. I wouldn't count on it this year, but who knows? The board makes some decisions that don't make sense. They include some companies that, in most people's opinions, don't belong. Companies that crash immediately after being, put into the S&P. So I
Included,
mean,
yeah.
there's a lot of variables at play. But I would, if I had to guess, I think when the non-interest segment is a bit more profitable, which is it is being carried by the loan platform business. So
Mhm.
as that keeps scaling, it should look brighter and brighter.
Okay, no, fair enough. I also don't expect them to be included this year. 26 probably a bigger chance for them, but
Yeah, I think so.
again, whether they get included now or not doesn't really change much. I rather just see the business grow a lot.
Yeah.
With that, if anyone has any questions, now is the time. In the meantime, this is what we're looking at for today, in case you're interested. We have a lot of green actually, across the board. AMD is up 10% today because people are still digesting, I guess, the OpenAI news.
Well, PayPal
Duolingo,
dropped. Damn. How much was it
PayPal,
up today? It's 1.65% today.
it was down.
I bought some leaps on PayPal actually today.
Ah,
It's my first time buying options. I don't know if I did a good job. I talked to Amit. So okay, I had to liquidate my whole portfolio last week, so I
correct.
missed the 20% up in FICO. I was kind of depressed by that because I had a lot of FICO. But now actually I got new funds into a new brokerage, and options are available to me now. So I was like, well, selling puts sounds amazing. You get premium to sell puts, and you can just sell puts at the level where you want to buy the stock anyway. So I
Hmm.
sold some puts on Robinhood at the price I want to buy the stock. Makes sense. But I bought some leaps for the first time, which is something I typically would never do unless I was extremely confident. And I only bought leaps on PayPal. So I bought I can share this. It's fine. Free nugget for the couch investor because I got to advertise my Substack. But yeah, typically all my moves are on the Substack. But about $110 leaps for January 2027. That is the
Ah,
biggest no brainer I've heard of my life. I don't
I
know
have
if I don't know if I overpaid, underpaid. I don't know what kind of delta, gamma, theta I should be looking at. So I asked Amit, like, can you give me a crash course? He's like, dude, don't min max leaps. Just imagine what you think is like almost guaranteed to happen, and then just buy them. Like, don't think too much. So that's what I did. So yeah, leaps on PayPal.
yeah.
Let's see how it plays out. But
No,
yeah,
but today PayPal was down at one point like 0.3%, and we're down and we're up 1.7. So I'm not going to complain. I'm not
oh
going to
really?
complain right now for
Yeah.
PayPal.
And if you want, the charting stuff, stay away from me. I never look at charts and don't even look at prices. I just do the research, get fair value, and then if the stocks I like are below fair value, I buy them. So that's like my simple approach. I never look at like charts or patterns or stuff like that. So I typically, even on a day-to-day basis, I don't really look like how my portfolio moves. I know that's one of the favorite activity of investors, like, oh, how much did my portfolio move today? But typically I completely ignore that.
So
um,
what you're saying is that if let's say Robinhood, you think that the price right now is above intrinsic value, so you're selling puts
yes,
at the price that you would like to buy it. You're
yes,
doing this just with Robinhood for now.
yes, and I plan on doing it with Palantir as well, because I believe both are slightly above fair value. Palantir more so than Robinhood. But I'm interested in like farming yield until I can acquire my shares back at what I
Hmm.
believe to be at or below fair intrinsic value. So selling puts as an idea sounds great. I don't see the downside. Like,
If you want to own it,
yes?
if you
If
want
I
to own
if I
it,
want to own it, is there any downside to this? Like, I don't know.
well, you could get if you don't want to own it, then yeah, that's the
Yeah, but
problem, I
if you want
guess.
to own it, I don't see any downside, so it makes a lot of sense. But the problem is if it keeps going up and you never get assigned shares that you want to own. So I guess that's like the only problem. But I mean, yeah,
Yeah,
it's a very low risk in general. So typically, I'm just being vanilla. Buy stocks, buy shares in companies you like below fair intrinsic value, and that's that. But we'll see. I'm
yeah, no,
experimenting a little bit with what makes sense to me. PayPal, 110 in 495 days. I mean, that's I, okay. If I've been so wrong on PayPal, I hope I lose that money, because this is like the biggest
yeah.
no brainer I've seen. Like like I want to see, like, okay, how could I get this wrong? I would be so surprised.
Yeah, I mean, what could go wrong is, yeah, if it keeps going lower and you have to buy it at a higher price than what it is at on
Yeah,
that
but
day.
that's fine if I'm fine with it being below
If you're
intrinsic value.
yes,
At that
you're probably
point, I would also start buying shares
buying
directly.
shares.
Yeah.
Exactly.
So I don't mind that. So yeah.
Exactly. All right. With that said, we've gone on longer than expected, but that's fine. There will be timestamps below. All the links for Emir's channel Substacks will be in the description and the pinned comment. We will be doing more episodes, talk about some other companies in the future. So I do appreciate everyone coming in. I appreciate Emir coming on. And we shall see each other in the next one.
Yes,
Bye
thank you so
bye.
much for having me, and thank you everyone for watching.